Dear all, welcome again to the International Fiscal Association, in short IFA, Asia Pacific Tax Webinars Program, hosted by the IFA Hong Kong branch. For the remainder of this year, please expect similar programs to be organized by India, Japan, and Korea, respectively. The chair of the IFA Asia Pacific Regional Committee, Kontal Dave, will say a few more words about this at the end of this program. As you might know, the IFA Asia Pacific is represented by the different IFA branches from the Asia Pacific region. Consequently, the panel members and participants of this webinars program are also from those various regions. You will be pleased to know that the following Asia Pacific countries, next to Europe and North America, join us today. These are Thailand, South Korea, Australia, India, Japan, Mainland China, Taiwan, Indonesia, Malaysia, New Zealand, Singapore, Sri Lanka, Dubai, Kuwait, Russia, and last but not least, also Hong Kong. We welcome you all. So my name is Willem Jan Hoekland. I'm a member of the IFA branch Hong Kong Executive Committee. As we have quite some participants, right now 78, we hope it will go up. The following house Zoom rules have been implemented by us. So the participants' mics all have been muted. They cannot mute themselves. If you have any questions, please raise them actually through the chat box, and preferably, of course, also to the moderator. And as far as you've not done so yet, please also make sure that your camera is switched off. So I would like to hand over the floor now to Stefano Mariani, who is also a IFA branch Hong Kong Executive Committee member and the moderator of the first panel session. Just one tip before we start to the panel members. If you do not speak, it would be better to also have your mic switched off. Over to you, Stefano.
Thank you very much, Willem Jan. If you cannot hear me, please let me know or drop me a message. Good afternoon, good morning, or good evening, depending on your time zone. It is my immense privilege today to have with me on this panel a number of distinguished speakers who will provide some insights on the evolving doctrines of indirect transfer and what we can expect in future. In no particular order, I am delighted that we have with us today Professor Yoshihiro Masui of the University of Tokyo, Mr. Mukesh Butani, Managing Partner of BMR Legal Advocates, Mr. Cameron Blackwood, Partner of Greenwoods Herbert Smith Freehills, and Mr. Thenesh Kannaa, Partner of Thenesh Renger and Associates. Before we begin, a salutary and brief reminder of what an indirect transfer is. An indirect transfer is a long-standing problem, not only practical, but one of principle at international revenue law. Effectively, the question is this: can a jurisdiction tax the gains arising from the disposal of securities or shares, specifically in a company which indirectly or directly holds property in that jurisdiction? And by property, we are primarily in the ordinary course concerned with real property, with immovable property, land, and natural resources. The question is a pressing one, especially for jurisdictions which are rich in natural resources, but perhaps less developed in other contexts. But it is also a pressing one for developed economies, which themselves have benefited from the natural resources boom. So in the representative diagram, which you see before you, you'll find a paradigmatic example of an indirect transfer structure. Country D is the jurisdiction in which the land is physically situated. Do we tax the sale of shares in country C, or sorry, the sale of shares of companies incorporated in company C or country B, and so on? Because each of those companies, it is understood, derives its value primarily, albeit indirectly, from immovable property situated in country D. That is enough from me for the time being. I would like to turn the microphone on for our distinguished panelists. And again, perhaps following the order of their introduction, as a starting point, could you each briefly introduce the indirect transfer rules, if any, in your respective jurisdictions? I can begin very easily by saying that capital gains, generally speaking, are not taxed in Hong Kong, irrespective of whether the corporation in question holds Hong Kong situate assets or otherwise. So that's a very, very simple answer. I suspect the answers in the other jurisdictions will be rather different. Professor Masui, what do you think?
In Japan, basically taxable, but indirect transfers are, of course, to some extent taxable, but the reach is limited. Back to you.
Thank you. Mr. Butani, what are your thoughts from India? India perhaps being one of the most important indirect transfer jurisdictions, which has given us landmark decisions like Vodafone.
Firstly, Stefano, thank you very much, and to the Hong Kong branch for inviting me. Yes, as you correctly observed, my first point is that India is one of the important jurisdictions, and in a way, India refined the indirect transfer law after the famous Vodafone decision, though I would say that India is not the inventor. It actually arose out of an administrative circular issued by SAT in China, but India did get into the limelight immediately after, weeks after, the federal court decision in Vodafone's case was legislated by way of a retrospective law in the Finance Act of 2012. We can discuss the details later as we get into the panel.
Thank you, Mr. Butani. Mr. Blackwood, Australia is perhaps one of those jurisdictions which is certainly economically developed, more so than most, but also happens to be rich in natural resources. How is the issue of indirect transfers addressed in Australia?
Yeah, it's a good question. So we have a system which, and again, looking at the topic for today as to what this means in M&A transactions, which is, it's relevant obviously for a vendor, but also relevant for a purchaser. So in broad terms, we seek to tax non-residents under both our domestic law and consistent with our treaties, where they are selling something which derives its value primarily from Australian land assets, which includes not only real property land, but also, yeah, as you alluded to, we are quite minerals rich, so it captures mining rights as well. We have a system which looks up the chain and broadly has a 10% threshold before a non-resident is subject to tax. On the flip side as well, it's all well and good to try and tax non-residents, but you need to have a mechanism to try and enforce the withholding. So a few years ago, Australia also introduced a non-final withholding tax where a purchaser is acquiring a land-rich instrument or land-rich share, for example, from a non-resident. So there's a whole regime which applies there. And in an M&A context, it means that purchasers also need to turn their mind to the potential application. The issues that we have struggled with, and certainly our courts have struggled with, is, you know, what does primarily deriving your value from Australian land assets actually mean, and how do you test that, and how do you test the 10% threshold and the like. So we in some respects follow the OECD standard, but there are some aspects to it that we depart, which we can go through in a bit more detail later on. But I think one of the interesting things in Australia is, as I say, the introduction of that withholding tax, which then forces purchasers to turn their mind to it, and means that this issue comes up in effectively every M&A transaction in Australia now.
Sorry, Mr. Black. So we're talking here about, this is taxation at a federal level, right? Not on a state-by-state basis.
Yeah, that's right. So we have, this is I guess the disposal, or when you sell an asset, so the income tax that is levied on the vendor. So this is basically when Australia seeks to tax that gain in the hands of the non-resident. All the other variety of taxes that we have at a state level, the state duties will generally apply. Regardless, we then have an additional regime depending on the type of asset where non-resident purchases are subject to an additional stamp duty. But very much what we've been focusing on is that the long arm CGT, so to speak.
Thank you. Mr. Kannaa, what about the situation in Malaysia? Malaysia, in ways, a jurisdiction whose tax code is very similar to that of Hong Kong. They're both based off the British Imperial Model Income Tax Ordinance. So what is the situation there? I understand as a general rule, there is no tax on capital gains.
That's right, but good morning and good afternoon or good evening as the case may be to the audience. So that's right, Stefano, that we don't have a comprehensive capital gains tax, but we have a real property gains tax, which also applies on gains arising from transfer of shares of property-rich companies. And we have a very clear definition of what is a property-rich company and what is not a property-rich company. And just like Australia or India, we also have a non-final withholding tax regime. So it's not just the seller, but also the buyer has to pay attention to these details when they are purchasing shares of foreign company that hold either properties directly or shares in other companies that hold properties in Malaysia.
Thank you very much. I think now is a good opportunity, after we've had this very helpful introduction to the different perspectives each jurisdiction has on indirect transfer. And now's an opportunity perhaps to gauge the principal basis for an indirect transfer, because of course the default position at revenue law is that it is residents who are taxable. And the corollary to that is that where there is immovable property physically situated in a given jurisdiction, taxing rights are by default allocated to that jurisdiction. But is there an underlying principled rationale for tracing that general and very simple principle that is land is taxed where it is physically situated through a series of interposed companies? So let us perhaps explore the foundational principles behind indirect transfers and how these are perceived and interpreted in each jurisdiction. In no particular order. If any of the panelists wishes to jump in, by all means do so.
Stefano, may I?
Yes, please do. Yes, I am grateful.
May I go back to the diagram?
Yes,
I think that would be very useful.
Just give you a moment, yeah. There you go.
Okay, thank you. I like this diagram very much. And I would like to stress the point that the land itself, the underlying asset, is within country D. So that means the country D as a source country can tax the unrealized gains at any time. So I think it is a matter of timing. Of course, there could be arguments to support taxing indirect transfer, inferring from the symmetry arguments. By analogy, if you tax the underlying asset itself, then you could close a loophole by deeming the source of the shares realized outside of your country to be sourced in your jurisdictions. I see that point, but if you look closely, it's really, you really have the underlying asset in your jurisdiction. So why don't you really go after that? The gain itself, rather than really going to the indirect transfer. That's my comment. Of course, Japan itself has a policy to quite restrictively treat the indirect transfer as arising from Japan, sourced in Japan. But my fundamental question is that we really have to look at the underlying economics and then to look at the underlying assets unrealized gains. Back to you.
Well, let me just play devil's advocate there for a moment. But let us say in this diagram, one buys and sells the shares in the company incorporated in country B. As a technical matter, one is buying and selling that asset. So isn't what you're suggesting really a variation or let me put it, a departure from the principle of separate legal personality? Because we're saying country D is in effect claiming a taxing right with respect to a company incorporated in country B. The asset properly being bought and sold is shares in a company incorporated in country B.
May I?
Please do, yes.
I would like to listen to other panelists' opinions, but I would like to go first.
I'll pass that same question to others, but
yes.
You jumped in first. I'm happy for you.
Okay. I think, well, as we discussed, and then, the policy towards capital gains taxation differs from country to country. But if you have a comprehensive regime, like in Japan, it is really a matter of a legislative discretion whether or not to deem on the tax the unrealized capital gains. So if the government thinks it is time enough to tax the underlying assets, then I think you can do it. And then it's much more straightforward rather than to go after a indirect transfer arising outside of your jurisdiction.
Thenesh, I see you're raring to go. Please, what's your input on this?
Yeah, I think the rules for indirect transfers cannot be omitted altogether, because otherwise it would be a very the reality is company C, companies, or the company in country C or the company in the country B may in cases have very little other assets, or may have zero assets in a third jurisdiction or even in country C, deriving all of its value from holding assets in company D, so or the country D. So if we don't have an indirect tax transfer at all, then it would be a very easy way out to lead to perpetual deferral of taxes, not just short term but perpetual deferral. That being said, I think another aspect is there's always a tendency to refer to the double tax agreement right away to see whether country D has the taxing right. But I always cautiously say, at least for the case of Malaysia, we must first see whether the relevant tax is part of the coverage of the double tax agreement, even before we look at the articles that deal with capital gains.
I was going to add to some of at least looking at that from an Australian perspective. So that point about ensuring that you can't avoid Australian tax, because clearly our policy is that the disposal, direct or indirect, of Australian land or Australian mineral rights should be subject to tax. So we actually had to put through in our domestic legislation a treaty override to overcome some defects in some of our earlier treaties, which only in this case would have allowed Australia to tax a disposal by the company in country C. So in other words, a direct transfer rather than, it was just as alluded to, a transfer up the chain. So certainly it's a bit of a mix, and some of the challenges with the Australian, so the way the Australian tax regime works is when you're looking at two aspects as to the scope of the taxation, which is an important one. So unlike the OECD, which does not have a minimum threshold, Australia would only seek to tax you if your indirect interest in the country D company, i.e. Australia, is 10% or more. So not everyone in an indirect transfer is subject to tax. So that can kind of limit the scope of what you're trying to tax. So similar to, I guess, the non-portfolio exemptions that we all know. And then likewise, which is different to the way it works in other regimes, is if you do have material other assets in country C or country B, that might actually make an indirect disposal not subject to Australian tax. So if there's enough non-country D assets in country B company or country C company, that could ultimately result in an indirect transfer not being subject to Australian tax. So these tests depend on at what level are you testing the value to Australian land assets in my case, and also do you have a minimum threshold before we seek to engage our taxing rights.
Stefano, if I may,
how about the view from India?
Yeah, if I may just chime in over here, I wanted to discuss a little bit about the international developments on indirect transfers. But before I do that, insofar as the taxability of immovable assets is concerned, Article 13.4 of the Model Convention governed it. And because these were bilateral treaty issues, the last survey that was released suggests that only about 35% of the total treaties have Article 13.4, by which indirect transfers, insofar as the underlying assets being in the nature of immovable property, are covered. However, the debate has gone beyond that, and specifically in the context of M&A transaction, you're looking at transfer of shares or transfer of rights, so on and so forth. Now, leaving aside country-specific issues, whether it's India or many of the African countries and other nations that have legislated indirect transfers, and each country exercising its sovereign rights on what kind of tax policy they want to pursue, have their own sets of policies. The issue over here is what kind of incongruous treaty interpretation do all of these disparate domestic policies outcome yield. And for that, it's important to note that the OECD, in collaboration with the UN and the IMF and the World Group, came out with what they call it as a toolkit on offshore indirect transfers. It's called OIT. This does not necessarily represent the official views of the organizations or their member countries, but it does give an element of guidance to many countries which they may want to adopt either as a part of the domestic policy or as a part of the treaty negotiation. And under what is called the OIT, the sale of an entity owning an asset in one country by a resident of another country is subjected to tax. The taxes are levied either as withholding tax or it's levied as a non-withholding tax. And the country in which the underlying asset is located may wish to tax those transfers, as is currently the case for direct or transfers of immovable property. And they have suggested essentially two approaches without any preference for one of the approach. The one is where an OIT is treated as a deemed disposal of an underlying assets, which seeks to tax the local entity as deemed to have transferred the asset. And under the second approach, the OIT treats the transfer made by actual seller at an offshore level, but sources gains on transfers within the location country, which is where the asset is located. There are several challenges with respect to location of assets, such as rights, so on and so forth. But the toolkit has left many of these guidances to the countries. So Cameron spoke about the 10% threshold in Australia. The toolkit suggests a threshold of 20%. India has a threshold of 5%, so on and so forth. At the slides later, I have discussed one case, which is the Sanofi case. It's a live case where the High Court has given an interpretation on treatment of offshore transfers under a treaty interpretation. The case is currently before the federal court. We can talk about it. But summing up, in the context of an M&A transaction, I think it is the other assets that pose computational difficulties and the domestic law invariably comes in friction with the treaty. The toolkit is, well, a non-binding guidance, but still I think the cohesiveness with which the countries legislate domestic law, in my view, are very critical for certainty in an M&A transaction.
Thank you very much for introducing the toolkit, which evidently is not binding in any way. It's not necessarily endorsed by the OECD, though I would expect it pretty much reflects its current thinking. Does anyone else have comments about the current state of international thinking on indirect transfers, and specifically any considerations on the toolkit as it is currently drafted?
I was going to add not so much on the toolkit, but I guess just looking at on what happened in the context of the multilateral instrument and what that did do to the OECD treaty, or standard drafting in a sense, which was really in a sense about strengthening the ability of countries to tax these indirect transfers, and it did that, as you would know, in a couple of ways, some of which we had adopted and other ones which are interesting. So one aspect was making it clear that the indirect transfer covered not just shares in a company, but also other types of instruments, such as interest in partnerships or instruments in trusts. The other important change there, which certainly Australia has not adopted as yet in its domestic law, but one of the issues is always, well, when do you test whether or not the relevant entity is land rich or not? And so what the MLI was doing was in effect having a 12-month look back. So in this case, if country D was land rich any time within that 12-month period before there was the transaction, then it would be called. I'll let others speak to the toolkit, but it's also just in terms of what we've just been through with the MLI in particular has all been about strengthening countries' ability, where they choose to implement it, obviously, their ability to tax indirect transfers, as we've been discussing.
Wouldn't the first point of reference in terms of ascertaining whether a given entity is land rich be its financial statements?
It's often that's the hardest point, because in a sense the financial statements provide a guide, but it becomes a valuation question. So there's been a number of cases in the Australian courts, to determine the value of, in particular, when there's mining rights in there, and how do you value that compared to, goodwill, for example, if to the extent a mining company can have that, or other assets. One of the other challenges that our Australian domestic law had to tighten up was, what do you actually take into account when you are going up the chain? So we had a situation where intercompany debt between group companies could, inadvertently, well, depending on whose perspective, I guess, either inadvertently or deliberately take an otherwise land-rich entity outside of the sphere. So some of the practical issues as to how you ascertain whether or not a company is Australian land rich or not, it becomes a valuation question. And if that ends up in dispute with the ATO in our case, it does lead to a very expensive and time-consuming process. And so there has been a fair bit of litigation in our courts on that very base question that one needs to answer in this, but it is often a difficult one to answer in practice.
That must be a difficult sort of litigation, because I would assume valuations are questions of fact and not of law.
Exactly, and that's why you then have ATO value versus taxpayers value, and then something in between. And once you have a dispute, as everyone knows, the worst disputes to often have with a revenue authority are questions of market value, and it becomes quite difficult in these type of cases.
Any other thoughts on the ascertaining what the threshold for land richness is, or anything generally which might arise? Well, let me rephrase. Let me rephrase because in India, how does one ascertain the extent to which an asset or is directly or indirectly derives its value from Indian real estate? Does one look at the financial statements, or is there a separate valuation exercise?
So it's a combination of both. India has very comprehensive valuation regulations, and these regulations were revised specifically to look into nuanced issues of valuations for the purposes of applicability of indirect transfers. So the way the regulations work is that there are charging provisions which clearly provide that the offshore transfer of assets should be of a nature where a significant amount of underlying assets should be lying in India, and that significant has been defined as the 50% threshold, which is also the threshold that has been prescribed in the toolkit. Thereafter, the pro rata basis of computation of capital gains is done, where the threshold is lower. It's 5% as compared to the standard 20%. The domestic law also provides that certain forms of internal reorgs by offshore entities are not liable for indirect transfer law. These reorgs are in the nature of spin-offs or amalgamations, and the only underlying condition is that these forms of reorgs should be exempted from tax in the jurisdiction in which these reorgs have been carried out. Coming to the valuation rules are split in two ways. Clearly, the market basis valuation is the determining factor. So you can have valuation of shares. There are a set of rules that are prescribed for valuation of shares. And then there are another set of rules that are prescribed for valuation of other forms of assets, including rights. But as Cameron correctly pointed out, in the context of natural resources, mining, though India is not a natural resource mining rich country, so we've never had any of the situations, but hypothetically, if it was supposed to be valuing a well or any form of a mining asset, it would clearly pose a challenge given the framework of the subordinate law that deals with valuations. But suffice to say that the valuation rules really focus on fair market value basis, discounted cash flow basis, methodologies that are internationally accepted from a M&A transactional perspective. But outside of the valuation of shares, I think valuation of business assets, particularly intangibles, do pose a challenge. And interestingly, even the toolkit says that countries are left to design their own subordinate legislation for valuation purposes, and they have emphasized on the importance of simplicity, but I doubt that that simplicity ever creeps in the minds of lawmakers.
How about Malaysia? What is the approach by the revenue authority when it comes to ascertaining the relevant thresholds?
Okay, so first of all, our threshold is rather comparatively high. Our threshold is 75%, which means a company would be taken as a real property company that is subjected to indirect transfer rules. Only if it ascertains at least 75% of its value from either real property or shares of other companies which are real property companies. It makes reference to market value, but in practice, valuation is not so much of an issue. Because, for example, if the scenario is such that company B in this diagram is selling off shares of company C, we don't ascertain the percentage on the date company B is selling the shares of company C. Instead, we go back to the date that company C had last bought a real property. And on that day, we look at the market value of the real property against the book value of all other assets and see whether that exceeds the 75% threshold. And if it does, company C is a RPC. Consequentially, if company B sells the shares of company C, the tax rules would kick in, regardless of whether on the date of sale, company C derives 75% of the value from country D. So because of this mechanism, usually a lot of effort goes on timing and digging out the old records and whatnot, but not so much on the valuation per se. Yeah.
Struggling with the technology as usual, I'm afraid. What about developments going forward? Where do we see the state of affairs when it comes to international, first of all, international consensus on the necessity for indirect transfers, or at least permitting them in the context of double tax treaties? And how might the law and international consensus develop over the next few decades, in your view? And does it vary? Does it really depend from jurisdiction to jurisdiction? Or are we going to see an emerging OECD consensus, which then translates into an emerging global tax consensus as regards indirect transfers?
May I, Stefano?
Please do. Thank you.
I see a clear direction when countries agreed on the MLI, and the Japan also adopted the MLI Article 9, and then the OECD Model Tax Convention Article 13 has been amended. So there is kind of a clear direction, but and also treaty practice supports taxing indirect transfer of immovable property. So I think there's a direction, but when I look at, for example, Japan-Malaysia tax treaty, because it doesn't match, our article on capital gains remains the same as previously. So I think there would be a trend, but there could be exceptions. Back to you.
Speaking from the Australian experience and looking at how Australia would view this, I would only see a strengthening of the regime. And that's really been evident in the fact that one of the challenges with having a regime such as this has always been, well, if the ultimate shareholder is selling their shares and yet country D/Australia is trying to tax that, how do you actually do that? And so in the last 5 years, as I mentioned, we introduced a withholding regime on the purchaser and in fact increased the withholding rate on it. And so I think that's evidence of, for a country such as Australia with so much of our wealth tied up in mining in particular, I don't see us moving away from that. And any changes in our regime and particularly looking at what was done with the MLI in particular, I would see only a strengthening and eliminating loopholes, I would suspect.
What's the view from India?
Yeah, so I agree with Masui-san that there are areas of convergence, particularly with respect to the MLI provisions, which are minimum standards now, which is adoption of Article 13.6. So all the signatories to the MLI will have to do that. But that is with regard to immovable property. I do see certain areas of divergence as well, which could arise either because of the debate at the UN level or because of certain countries pursuing strict source-based rules, particularly in situations where they want to invoke these rules in the nature of anti-avoidance, which means that treaties could be overridden. So let me just give a couple of examples on developments on indirect transfers where I see areas of possible divergence or friction. First is the UN committee. So the UN subcommittee on tax has opined that insofar as application of Article 13.4 is concerned, the percentage has to be left open and not pre-decided, as has been recommended in the OECD toolkit, and that this should be decided by the countries through bilateral negotiations. So this is, which means that in a way, if you give effect to the UN proposal on Article 13.4, to some extent it dilutes the MLI minimum standard. And we should bear in mind that most of the UN committee members are signatories to the MLI under the inclusive framework. The second is if countries are going to follow strict source-based rules by invoking anti-abuse provisions, then the treaty benefit may not be available. For example, the case that we are going to discuss subsequently is an example where the court came to the conclusion that India's indirect transfer law did apply to the offshore French entity at the time of transfer of shares, which had an underlying asset in India. However, under the India-France treaty, the right to tax that capital gains was with France, and hence under the treaty, that income is not applicable. Now, imagine a situation where an anti-abuse law is invoked and treaty benefit is denied. In those situations also, you would have friction and inconsistency despite the MLI provisions, which, as I had mentioned, are in the context of only immovable property.
We envisage at some point that international taxation will begin to presuppose the application of indirect transfer provisions. And I ask this, and perhaps this is primarily relevant both for Hong Kong, Malaysia, Singapore, those jurisdictions which still have territorial taxing regimes, right? We find ourselves as a round peg in a square hole, or vice versa, in the sense that it is assumed in most international tax guidelines and legislation that jurisdictions tax primarily on a residence basis, and we do not, we tax on a territorial basis. So is there going to be in due course a global consensus that indirect transfer is the default setting? It is the way to ensure fair taxation, whatever fair means, in the context of immovable property, and it is the standard which most jurisdictions should adopt. They don't necessarily have to, but increasingly there'll be pressure for them to do so. Do you think that is the future of indirect transfer, an increasingly universal global fiscal norm? Let's start perhaps with Japan.
Okay, that's a very important question and also difficult to answer, I think. But what I would say is that just following Mukesh's explanation of the toolkit does not show preference between model 1 and model 2. And then model 2 is the direction that we are talking about now. But there is always another possibility to pursue model 1, which is to look at the underlying asset itself, and then to have the deemed realization regime. And it seems to me that no jurisdiction among us, 5 of us, adopt this regime, but there are some examples in the world which are shown in the toolkit. So I think, well, I think that seems to be a little bit more straightforward. And also, I'd like to add another thing in response to Mukesh's reference to GAR-based approach. The toolkit itself is mindful of the difficulties associated with the GAR-based approach. I understand that if you have the detailed rules, like having the threshold or the evaluation, and of course that's very difficult to administer, but to me, that seems better than the totally discretion-based principles. Back to you.
What about the view from Australia?
Sorry, I just was on mute. Yeah, I think I'd probably just reiterate what I was saying before. I think our what we have shown in the past is we've been prepared to go down the unusual path of putting treaty overrides in our domestic law, which kind of shows you where our policymakers' heads are at. That said, though, I mean, I think one aspect which which Australia certainly has done, and I wouldn't see us moving away from, is adopting that minimum threshold. So just on this slide, what that means in practice, and I think one of the questions from the audience was, well, at what level is the 10% tested? And that's really, you know, before, that's not so much the value of the land, but how much of a direct or indirect interest, you know, should you have before Australia would seek to tax. And at its simplest, it's just in Australian context, it's a tracing exercise. So if you're selling your shares in country B, in that company, so the ultimate shareholders, it's just a tracing exercise of going down the chains and to see how much you have. That is one aspect where we do have a look back rule. So, you know, you can't get yourself out of those rules by staggering your sales. So your last sale is below 10%. So yeah, I think from an Australian perspective, just reiterate, I just don't see us moving away from us seeking to tax those regimes. But some important aspects as to if it does get wider use is whether or not, you know, similar to a dividend participation exemption, for example, is 10% the right level. Certainly that's what we've used in our domestic law for capital gains.
Treaty overrides, I mean, the final comment before we go to questions, but I'll pass the proverbial microphone on as regards to treaty overrides, specifically to India and to Malaysia, to give some perspective on that doctrine. To what extent, if at all, is it relevant domestically where you are?
So if I may go first, the treaty override is an important question because it concerns a bilateral obligation between the two countries. And following the fundamental principles enshrined in Article 31 of the Vienna Convention, it is the understanding of the parties at the time when they entered into a tax treaty which stands, and any subsequent amendment made to the domestic law of either of the countries would be viewed as a unilateral measure. Having said that, I would not consider the domestic car as a subsequent development, particularly because of the action points under BEPS, which are clearly redefining the preamble to the treaties. But as Masui correctly pointed out, leaving the GAR debate on the side, specifically with respect to a country's right to tax capital gains, I would say that treaty should come into play. And despite the indirect transfer law, which brings to tax under the domestic law such forms of transfers, it is a treaty that should override the domestic law, and hence the supremacy of the treaty in the context of indirect transfers should be preserved under all situations.
Thank you very much. Do all members of the panel have before them the questions posed by the audience? Can I just ask, does anyone please confirm that for me? Does everyone know? We all do. All right. Well, let's take each one in turn then. Let's have a look. Is there any sale 3? What does that mean? I don't quite understand the question. Does anyone want to venture as to whether?
I think that was picking up a typo on the slide I sent through, which referred to sale for. So a nice, easy one to begin with. And I think I've dealt with the next question, which was how do you determine the relevant 10%? So as I was alluding to before, if you go back to the last slide or that diagram slide, there's always two questions you're having to answer. One is, do you have the relevant 10% threshold? So in this simple diagram, that's obviously just looking at a chain of companies beforehand. So in a group context, relatively simple, you look at your direct and indirect interests. Where in an M&A context, and particularly when you're trying to comply with the withholding rules, is Australia, as we often do, applies that 10% test on an associate basis. So you can be looking at, not just the direct or indirect interest in one chain of companies, but looking at various, who are the associates of those companies up the chain, and certainly some of the difficulties that does arise is those rules are, don't just look at direct or indirect ownerships. There's a whole range of other tests. And so inevitably with these type of rules, the further you go up the chain and the more countries you're going through and into different entities, that's where from a practical M&A perspective, where as a purchaser, you're trying to get a handle on, well, do I have a withholding obligation? When you have entities who are up the chain, it does get difficult to form that view and just necessitates a discussion. Also, our revenue authority does have mechanisms to find out about it if you don't withhold. And so, like most countries, we have a what's known as a foreign investment review board. So basically, when non-residents are seeking to acquire certain stakes in certain industries in Australia, there's a approval process before they can do that. And the way it works now is the Australian Taxation Office is heavily involved in that process, so they can kind of put two and two together. So in terms of that second question, that 10%, that's often a big one. The other important one, as I was mentioning, is that valuation question. So currently we look at more than 50% by value. Other jurisdictions, and I think the MLI isn't prescriptive as to what is the asset threshold you need to have before you get caught.
Sorry, thank you very much. So there's always a bit of technical. The other question which has been put to me, which I should probably answer now, is about the slides. Unfortunately, we were not able to control the slides properly because we can't give control of the slides to all the panelists, but we will be circulating a version of the slides for everyone to review in due course. So please don't worry. We will provide those slides to anyone who wants them. Are there any other questions for the panel? Someone stuck his hand up, ominously and ominously named only iPhone, stuck his hand up. If you've got any questions, please send us a message directly.
I might have a question for the other panelists. So, one of the things I've alluded to in an M&A context is this withholding regime, particularly for the other jurisdictions which are imposing this long-arm CGT. What are the methods that your revenue authorities try to collect the tax off the offshore non-resident who's up the chain a bit?
What's the view from India? That's an excellent question, and it goes to the practicalities of it.
Sorry, Cameron, can you repeat the question? I'm not sure if that.
The question was, so it's one thing to impose a tax on a non-resident who's doing an indirect transfer. It can be altogether another thing as to how do you actually collect that tax. We have a withholding regime on the purchaser, so I was interested to see how other jurisdictions manage that practical question.
Correct. So India also has a withholding tax regime. In general, under the Indian law, the withholding tax requirements are very onerous. and they have been made even more stricter in the context of withholding tax liability arising on capital gains on indirect transfers. So the law has two-staged checks and balances in place. One is a declaration which is required to be made by the Indian company whose underlying assets are getting transferred. And then there is a withholding tax requirement to be made by the transferor. And even if the transferor is located offshore at 2 levels, 3 levels, 5 levels beyond India, it's an obligation imposed on them. Just in situations where a transferor is unable to fulfill those obligations, the tax authorities have a right to recover these taxes from the Indian company, which is considered as an agent of the non-resident for the purposes of withholding tax liability. So the law works in two ways. One, an obligation on part of the Indian company whose underlying assets are getting transferred at an offshore level. This is a reporting requirement. And second, an obligation on the offshore transferor for withholding tax. And in the event that process fails, the obligation shifts back to the Indian company as an agent for the purposes of recovery of withholding taxes.
I think in the case of Malaysia,
please continue, yes.
In addition to the withholding tax, there are certain cases the gain itself may be assessed on the acquirer rather than the purchaser. And that includes what we call as Section 16 situations, whereby the acquirer did not fulfill the responsibility to pay the withholding tax or to submit the relevant return. So when you fail to do both of these activities, therefore, even not just the withholding tax, but also the gain, if it happens to be higher than the withholding tax, may be assessed on the acquirer rather than the disposer.
And I assume that there is nothing in Japan, so there's no point. But if, just from a Japanese perspective, at least in principle, is there any indication as to how Japan would, if it did ever enact an indirect transfer regime, how would go about doing that? Because I mean, Japan is a very different, I'm conscious, very different fiscal jurisdiction relative to India, Malaysia, and Australia, which of course are all common law jurisdictions.
Well, we of course have the regime itself, but the no withholding mechanism, as is accidentally shown on the slide now. But and I don't see so much discussions, so many discussions on this issue. But I would like, I really wish to say that if you really cannot enforce it, but the idea is don't do it.
Right, so thank you for that clarification. Yes, so I meant Japan doesn't have a withholding mechanism. So yes, so if you can't enforce it, don't do it. That's right. So basically it would depend on self-reporting to a degree if there were no direct means of enforcement, say by withholding.
Yeah, and also I am wondering if there is a case of extraterritorial application issue in public international law if you are really obliging foreign vendors or foreign acquirers to do something for you. I'm just wondering if, well, I don't see there are such a stringent court-based monitoring mechanism within Asia, like in Europe, but still, I think potentially that should be discussed.
Dovetails very well into our previous debate as to whether indirect transfer legislation might become a global standard and no longer limited to certain jurisdictions, but basically expected of all. Well, thank you very, very much, both to the panelists and to the audience. We have one more question, Jutta. The question is, in your experience, do these developments affect the way M&A transactions are being structured? We have very quickly. Does anyone have an answer to that?
Oh, look, in Australia, not so much in the structuring, but it is something that has to be looked at in every deal. So to put it this way, in every share sale and share purchase agreement in Australia now, there is a mechanism to deal with this. Where it does get very complicated is in a public context where you have a significant offshore investor. There are a whole bunch of other complications in it, but it is, from a structuring perspective, you know, maybe the further up the chain and you don't have enough Australian assets perhaps, but certainly there is just a whole bunch of mechanical aspects and important mechanical aspects which have to be looked at. And I think really the fact that a purchaser can end up having a liability if they fail to withhold. And so a lot of work is done of mitigating that as much as possible. So yeah, it's a critical thing to consider.
And I mean, just one last point, Stefano, with your permission.
Of course, with pleasure.
I think there are, from an M&A transaction standpoint, I would say two areas of caution. One is in general on any form of M&A transaction, be very careful of tax indemnities because most transactions miss out on tax indemnities in the context of application of indirect transfers. That's been my experience. The second, which is very specific to India, is because our subordinate legislation evolved and it took 3 to 4 years to evolve, and still it's evolving in nature because of the nuanced issues of interpretation. In some situations, it is not even clear whether the indirect transfer law will apply or not. And there the advice from an M&A standpoint is for seeking suitable insurance to be able to cover withholding tax liability, if any, it arises because of the action of the tax administration. The court process in India tends to be very lengthy. And even if you are reasonably confident about your position based on opinions, you still have a level of risk as to what the tax administration will view it, particularly at the lower levels. And hence, these forms of insurances are very, very practical advice in transactions.
I totally agree with Mr. Mukesh's position. That's exactly the advice that we would give in Malaysia as well.
Very much again to all the distinguished panelists, and thank you to the audience for your questions. I think that wraps up our session for today, and I should be pleased to pass the floor back to Willem-Jan. Thank you very, very much for your participation, for your attendance.
Thank you, Stefano, and all panel members for your contribution and insights. We now have a 15-minute break, and we will start sharply at 2:15 for the next session. That will be regarding future types of information exchanges and tax cooperation. What lies beyond the horizon? So stay tuned and see you at 14:15.